So I get a lot of questions when it comes to real estate investing, whole life insurance, the cash flow hacking thing. I've written my book, Cashflow Hacking. I've got the revised version of this book that is massively enhanced. This is a 90-page book. My new book is going to be over 200 pages. It's going to be a much more in-depth and elaborate conversation around how to utilize whole life insurance in a lot of different ways to improve the financial efficiency for cash flow investing in a lot of different ways. The whole cash flow hacking thing started by utilizing whole life insurance and real estate, turnkey real estate cash flow investing. That was the initial inspiration. It's expanded beyond that, but I get a lot of questions about just investing in cash flow. Do I really need to utilize a whole life insurance policy, or should I just go out and pay cash and invest and get loans and whatnot in my house? Now, I've done a video and I'll link it on the end screen here, so when you get to the end, you can check it out. And it's the best way to buy a house. Now, you can look at that. It's gonna talk about primary homes and investment homes, but it talks about all the different principles. Should I pay cash for the house? Should I invest in the house? Should I get a mortgage? Should I finance it? What kind of mortgage, a 15-year versus a 30-year? What kind of a down payment should I put down? All these different topics, and it's going to educate you to all the different variables. How does inflation impact my mortgage? How do all these things kind of come into play? Now, at the end of the day, what I'm doing with whole life insurance is I'm just making everything more efficient. So in this video, what I'm going to do is I'm going to show you exactly how to utilize a whole life insurance policy to enhance my real estate portfolio. And I'm going to use extreme principles in this video to show a point and to really expand on this concept a little bit. But I'm going to show an Excel sheet that shows, with certain assumptions, and I'll explain them. I'm going to use an Excel sheet that shows what would it look like if I, over the next 25 years, buy real estate investing without a life insurance policy. And then what I did is I took those exact same numbers, and I plugged them into a whole life policy, showing loans, paying back the loans with the cash flow, utilizing everything I talk about in the cash flow hacking book. And what does it look like at the end of those terms, right? If we can compare those two, what I'm going to show you is that by doing it with whole life insurance, you end up with hundreds of thousands of dollars extra, and those hundreds of thousands of dollars can create extra cash flow above and beyond the real estate in retirement. It's really powerful stuff. So let's get into it. Hey, what's going on, cash flow hackers? It's Chris, and as I just told you, we are getting into cash flow hacking, and I'm going to show you an Excel sheet, and I'm going to show you an illustration, completely broken down, showing policy loans, paying back, dealing with cash flow. I'm going to take as much time as I have to here to kind of break this down and explain it to you, show you so this all makes sense, show you how to utilize whole life insurance to enhance your real estate investing. Now, if you understand this principle, this is why I'm a big believer, you need to utilize life insurance, whole life insurance with a participating mutually held company to buy cash flow producing assets, right? It can be it shouldn't be cars. It shouldn't be things of that nature. Those depreciating assets, because listen, I know there's a lot of people over the last couple of years that cars have appreciated, but now they're depreciating. I just went to this mastermind the other day, people that were buying cars like Rolls Royces and Audis and these kind of big fancy cars that, supercars, let's call them, that were doing really well, and people were able to flip these cars and make money. But now the economy is kind of taking a turn, and it's not going so well, right? Like, these cars are going down in value already. People are losing money. Kind of like homes, they're getting upside down in these mortgages. So people are upside down, and their cars are upside down in their mortgages right now. I mean, as a side note, I just saw a statistic. 25% of FHA homes that were bought with FHA loans over the last 18 months are now underwater. That is a really, really scary statistic when it all breaks down. So what I want to do is I want to share my screen. I'm going to share the Excel sheet that I did. I'm going to share the illustration that I did, and both of them are going to share the exact same numbers. So let's just do this. I'm going to get into this, and I want to show this to you. I think it's really powerful stuff. I'm gonna be looking up. If you're seeing me in the upper right corner here, I'm gonna be looking up because my monitor is sitting up above me here. And so that is what it is. But let's just get into this. Now you can see here, I'm assuming that we're buying rental properties that are $200,000. You could see that I'm saving, I'm assuming this individual had $200,000 saved, and the assumption is that they're saving $2,000 a month with the purpose of investing in real estate, right? I've got some assumptions here. I'm going to share the formulas with you. 5% annual real estate growth, that can be maybe higher or lower, but historically 5% I think is a good number. Obviously the last couple of years have been way bigger than that, but I think we're in for some contraction in the markets, and at the end of the day I think it all kind of reaches the average of about that 5% when it's all said and done. Average cash flow annually is 8%. I think this is a really conservative number. And once again, we're saving that $24,000 per year. You can see this $24,000 going into the formula. D3 is I'm adding the $40,000 there, plus the C4, which is adding the amount that I had left over cash savings in my savings account, plus the cash flow going back into this. Now, this Excel sheet is assuming that I'm doing this all in cash. I'm not utilizing a whole life insurance policy. I'm not utilizing a policy loan or anything of that nature. I'm doing this all in cash. Once again, if you want to go back and watch the video on how to buy a home properly, whether it's an investment property, it breaks down the 15 versus the 30-year mortgage. How much should you put down? The concept of opportunity cost. It breaks down how inflation impacts your investments and all the different variables you need to look at. I'll put that on the end screen. You can check that out. But at the end of the day, what we're doing here is you can see year two, we're buying our first property. At the end, we have $40,000 of cash left. We always want to make sure we have a little liquidity just in case something goes on with the properties, or if we have tenants that kind of bail on us and we need to cover the overhead or something of that nature. You can see 5% growth here in our real estate portfolio value. We've got one property at this point in time, and our portfolio value is going to grow by 5% per year. And typically what we do is we add in 5% rental increases. So if the rent is $1,000 a year right now, next year it's going to be $1,050, 5% increase every single year. So we're going to keep the cash flow consistent at 8%, and as the values of the property go up, it's going to go up. Our cash flow is going to go up accordingly, right? Now, as we hit $200,000, we're going to buy our next property. So you could see here we've got the minus $200,000 from the savings account, because what that does is it goes over to here and it goes into the property value. We're buying an extra house and our property amount went up. Now you can see it took till year 7 to buy the second property. It took till year 10 to buy the third. It took till year 12 to buy the fourth. Year 14 to buy the fifth, and then 15 we bought the sixth. It's 17 we were able to buy the seventh, and it's just all about cash. This, once again, this is just a spreadsheet. It may be a little less, a little more, but by year 25 we had 20 homes, and it was what it was. And the other thing I want to show you here is that I shifted this because you can see we're saving $24,000 a year. This is the policy over here. This is the premium amount. $24,000 a year. At year 16, it changes to $21,634. At year 16, I changed that $24,000 to $21,634. Full transparency, what I did is this, for the policy, whatever the cash flow was from these properties, I'm utilizing the policy as a savings account instead of over here. I'm borrowing against the policy to buy the houses. You can see here, year 2, negative $167. That is the overall increase in net cash value. We're using $200,000 to borrow against it to buy the house, but then we're making the premium payment. So that is the net growth is assuming that $200,000 is coming out to buy that house. I'll show you down below kind of how that happens. I'll get into deeper when we get over here. But we're paying back the loans. We're utilizing this cash flow every single year. In column C here, we're utilizing this cash flow as the loan payments to recapitalize our account over here to be able to do it. Now you can see year 2, year 7, year 10, year 12, year 14, year 16, 17, 18, like we're getting all the same houses, the same exact thing. At the end of 25 years, you're ending up with 20 houses the same exact way. Once again, we could do this without paying cash. I would, if you're looking to optimize and really leverage and take advantage of appreciation more, I would say leveraging it makes more sense. You don't want to pay cash for houses unless you want to be really, really conservative. This is the most conservative way to go about real estate investing. It is. There's no leverage. It's completely safe. Even if the market took a 50% dive, you have whatever cash flow that we're showing. Now the cash flow may go down a little bit depending on what rents do. This is the most conservative way to go. It's not the way that I would personally go. I'm just doing this on a spreadsheet to show a principle. And if the extreme principles of paying cash work in this instance, then it gets better when we start talking about adding a little leverage in. But anytime you add any sort of leverage in like this, it does bring risk to the table. So you just need to understand your tolerance and manage that risk accordingly, right? So that's just important to understand. So you can see here, here's the deal. We have this kind of cash flow. By the time we hit year 25, we got $467,000 a year cash flow. And if that were to go up by 5% the following year, that cash flow is just gonna keep getting better and better and better. And it is what it is. Now year 25, we've got $186,000 of cash there, $738,000. So you have the death benefit, you have the cash value, and now you have the cash flow. And so what I would do is I would utilize the cash flow to pay these premiums back. And what happens here, and the reason I'm doing this is because, check this out, in doing so, I'm recapitalizing my reserve. My death benefit goes back up, which is great. This is all tax efficient money that's going into this place. There's not another vehicle on the face of the earth that's going to give you the guarantees and the returns that this product, that this policy will give you at this point in time, right? And so I'm always wanting to recapitalize this because now we're talking generationally, right? Because we're going to have this real estate portfolio value. We got $5.8 million of real estate with $467,000 of annual cash flow. That is going to sustain us for life. You know, maybe you take a portion of this cash flow and you pay back the loans over a little longer period of time to get them back to good, and you live on some of that and you retire. But the beautiful part is when the real estate passes on to your heirs, you're going to get other benefits like step up in cost basis and stuff of that nature. You know, maybe you put it in trust, maybe you have a property management company manage it so your kids don't have to deal with it. They just get the cash flow, stuff of that nature. But here's the deal. This money is going to go completely tax-free to the next generation. You can once again set it up in a trust, do whatever you want. However, you're talking about $69,000 once you do that, $69,000 of growth all the time. You can see the net increase in net cash value, $69,672. This is with today's low dividend rate assumptions. I think this is ultimately going to wind up being better than what I'm showing you here because I think interest rates are going to go up. Of course, this is 30 years from now, so they could go up and come back down by then. But there's a lot of variables in play. This is a really conservative number though, because we're near the lowest dividend assumptions with looking at this spreadsheet that we've ever been at in over 120 years with this company, right? And so 1.277 million, 69,000, that's almost 5.5% annualized tax-free returns on this money. And you can utilize this for growth. You can see if I never touch it, which let's face it, if you have this cash flow, you probably never need to touch this. You could recapitalize, you could buy more properties, you can leverage it in whatever way you want, but you can see it's gonna grow, it's gonna grow, it's gonna grow, and it gets better and better and better and better and better. The cash value grows. By the time you're at 45 years into it, 85 years old, you got a $3 million death benefit, $2.6 million net cash value. It's a pretty powerful vehicle at that point in time. And when the only way you do this is let me put it to you this way. This is why we utilize whole life insurance for cash flow hacking. You don't do this with IUL, you don't do this with any other product. It's gotta be a whole life insurance policy with a participating mutually held company. We've got a list of companies that we work with. You can feel free to reach out to us if you have any questions about any of that. We're happy to give you advice. On a one-on-one basis. I will not give company names in the comment section below. It's a compliance thing. I'm not allowed to. So just know that if you ask, I'm just letting you know right now, I'm not going to respond with specific company names in the comment section below. You got to reach out if you want to know them. And we go from there. Now, here's the deal. This is just going to get better and better and better on a tax-free basis. But here's the deal. At this point in time, it's just done, right? Like the cash flow will grow based on the property value, but everything else, you don't have this other account growing, right? Over here, you could see, once again, we're gonna use the policy loans to pay it back. And when we do, you could see this is the net increase in cash value right there. It's growing from there. And this policy is gonna grow and grow and grow. Now you can see, yeah, these premiums are due, but the bottom line is that this is fully paid up at 75 years old, so 35 years into the policy. What we can do, and I didn't show it in this policy, but what you can do is utilize a premium offset, meaning at this point in time, you're 26, you don't have to utilize, I would say actually you're 27, 28, we don't have to utilize cash out of our cash flow, even though you've got it, so you can if you want to, you just gotta make that decision. But we could utilize a premium offset and utilize the dividends to make the premium payment, and this is gonna continue to grow and grow and grow and grow. So at the end, we'll have not only the cash value, what the property value are, what the cash flow is, I could run this out for 40 years if I wanted to, but we'll have that, plus we'll have all of this cash and the death benefit and the tax-free efficiency that this policy brings to the table all at the same time. So that is really, really powerful stuff when you start looking at it and you start comparing, okay, if you know you want to do real estate and you know you need to save up and do that real estate, now the next question is, what's the most efficient way to buy real estate? That is why I wrote my book, Cashflow Hacking. That's why I have the revised version coming out in January, so make sure you're on the lookout for that. And that's why we have all this stuff going on. This is all about financial efficiency. So if you're gonna buy real estate, don't just get real estate. Buy real estate in a way that says, okay, you can have everything work the same way, but at the end of it all, you can have an additional asset on top of it, and that's what it's all about. So if you have any questions, comment in the comment section below. I will do my best to engage with every single one. If you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Hope you found value in this. And once again, I guess I should say, if you do have any questions, feel free to go down in the link in the description below, set up a call with one of my coaches on my team. Happy to help you in any way we can. And that's it. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.